Monday morning, Market Chameleons, and soon to appear the King Chameleon, Dimitri Pargamanik. How are you doing this morning, Bima?
Good morning, Will. How are you?
Excellent. I think I have the disclaimer up right now. You want to go right to the disclaimer?
Yep. So good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not registered investment advisors. We're not broker dealers. We're not telling you what to do. We're just sharing ideas. If you need professional help, call your broker. That's what they're there for, to help answer your questions and provide you with guidance. There's the disclaimer.
All right. I put a couple links in the chat already, D. I put a link over to the Zoom meeting. So if anyone has questions for you, they can come on over and raise their hand, and we can get them on with their voice if they want. No need to put on the video.
Yep.
Also, I put a link to the IBKR webinar tomorrow at 2 p.m. You'll be discussing some interesting things on that webinar, so everyone should log in and register for that. Anything else?
No, that's it. I think that sounds good. We'll do tomorrow the webinar with interactive brokers. Today, I think we're going to discuss option straddles, and I think we discussed credit put spreads. People use iron condors, but let's take a look at just option straddles, because that's a concept for options traders that you really kind of need to also understand, because a lot of people use options like, they'll use implied volatility as a reference to, entering trades. And I think that when we kind of look at an option straddle, it'll kind of clear up a little bit of, maybe when to use implied volatility. Maybe implied volatility is not actually an appropriate measure to do an options trade based on the situation. All right. I think you'll understand it a little bit more once I discuss it. But most professional trades, kind of because they're hedging, kind of do a straddle. All right. Like it turns into some sort of a straddle, when they trade delta neutral. So when we look at professional traders, most of them, when they do an option, it turns into some sort of a straddle. So we'll take a look at that today, open it up for discussions, and maybe just so people kind of visually maybe get a better idea of, like, an option straddle. Sound good?
Yeah, perfect.
All right. Let me share my screen real quick. And by the way, this weekend I didn't know. Did you know what a YOLO stock means? Did you even know what YOLO means? Because I didn't. I'd heard of FOMO, like fear of missing out. I didn't know what YOLO means. I kept hearing a YOLO, and I'm like, is that like a Robin Hood thing? Like, is that what I thought that they refer to, Robin Hood traders as like YOLO traders? But did you know what that stood for, Will?
It used to mean you only live once, but I'm not sure.
Yeah, you only live once. It's a you only live once trade. That's pretty funny.
God,
but I had no idea.
I was sweating. I didn't know if I
didn't know
the acronym had moved
I didn't
beyond
connect
to something new.
Yeah, I had no idea. I was, I'm reading all these articles, and I keep seeing YOLO trades. I'm like, is that what does that mean? Is that like Reddit traders? Like, why do they call them YOLO? So you only live once trade. Now and then they have the FOMO, obviously fear of missing out. What's the difference? Is that the same thing?
I don't know. The man to ask is Jake, because Jake uses it a lot in both his writings and his commentary.
Yeah, Jake. So let us know what's an example, the difference between a YOLO and a FOMO trade, because they sound to me almost the same. Is it the same thing? Like,
he goes to football analogies because he knows you love them. He says it's
I'm going to do a football analogy today.
He says it's a Hail Mary. So you're just tossing the football up for one long hope that someone grabs the ball. And, so it's, right. You're closing your eyes and buying the stock and hoping it goes up. Right.
Right. All right. So, well, it's interesting because that's, just this weekend was the first time what does this YOLO mean? Here's an interesting, I'm going to start out with the pre-market report. We're just going to take a look at, before we go to the straddle, what's moving, what's trading in the pre-market hours. We have the most active stocks here, biggest percentage gainers, biggest percentage decliners. I know there's some news on Tesla. I think it's down 4%. What happened over I think Elon put out a tweet if people agree that he should sell 10% of his stock, he will do it.
Well, the tweet actually had a poll attached to it, so actually people could vote, and so I guess 56% said he should sell the stock.
He should sell the stock.
Yeah, and he said he would
Yeah,
absolutely, whatever the poll ran for the weekend, it's millions of people polled,
right.
and he would do whatever the poll said.
So what were the percentages? Do you know?
I want to say it was like it was 58% said yes, sell it.
Oh, really? Okay, so
yeah.
It wasn't like an over,
and it's like 10% of his stock, like $21 billion worth of stock at this price. So
that'll be interesting. But here's this interesting. Maybe we should do a poll here. I see Tesla right now. It was a $1.2 trillion market cap stock at this point. The same as Bitcoin, right? So Bitcoin is a 1.2 trillion. So I'm just curious what people think.
So is the poll buy Bitcoin or Tesla? Which would you buy?
Which would do in 5 years? Which one will be higher? Like I'm just curious to see what people think will be higher. Because that I think that's an interest. At this point, Tesla.
So you want to know?
You're betting on a.
Will Bitcoin be worth more than Tesla in 5 years?
Yeah, in 1 point, yeah, because I think at this point you're investing in Tesla. You're investing in a future outlook, right? That you think that Tesla is going to eventually make, enough money, innovate, and do well enough to justify its current market cap, right? Of 1.2 trillion, because that's the debate right now. If you look at similar stocks, they're generating way more money than Tesla is. So at 1.2 trillion, you got two, and then you got Bitcoin. Like, what would last? What? Let me ask you that: in 20 years, which one will be around? Which one is more likely to be around for a longer period of time, Tesla or Bitcoin? Because the interesting thing about Bitcoin is it has no earnings, right? It doesn't have to make revenues. There are no employees. There are no taxes. There are no regulations.
Well, I think you can earn something on it, right? If you own it, you could lend it out. Is that
you can mine it, or you could lend it out? So it's true, but in essence, it's not a company, right? It's not a company that needs to, meet payroll and have debt, and so it's not that type of an asset, right? Because like when we think of it like a painting, right? A painting can outlive almost any stock out there, right? It will, over the long period, as long as people believe in this artist or painting, it will exist and potentially grow in value. But so what do you, if you have a Tesla or Bitcoin, I'm just curious to see what people think in 5 years from now, which one would be the better trade?
Well, just so you know, it's right now with a minute into the vote and 16 votes tabulated, 56% say Bitcoin will be worth more than Tesla in 5 years.
All right, so that's very interesting. Okay. So let's just really quickly, let's just take a look at the pre-market right now. I'm seeing there are 231 stocks that made our percentage gainers list, 44 on their percentage decliners list. So from that perspective, we're looking at a bullish bias at the open. I'm going to take a look at the. By the way, Will, what do you think? I'm just curious to what your thoughts are on it.
I would say Bitcoin myself. Bitcoin will have a higher market value than Tesla. I think
Tesla in 5 years from now.
It's the people who are passionate Bitcoiners they're hard to eliminate Bitcoin from their wallet. They want to own it, and they seem very long
people about focused. Tesla as you do it. Yeah, the passion is there on both sides. And look, you have to make the choice, right? Where do I put my capital? And it's interesting, to see where, which one will win out at the end. And like you said, you could own Bitcoin, and there are ways, or any other tokens, that you could stake and earn. You could still make interest along the way, right? Some kind of yield along the way.
Though Goat pops in a good point, and by they, I'm assuming he means governments. He says they are trying to eliminate Bitcoin, so I say Tesla. There are elements that would like the cryptocurrencies to absolutely be made illegal, right? And that is a risk.
Yep. I mean,
it could make them more valuable, right? Too.
It could make it more valuable, but right now, I mean, if you look at the infrastructure bill that just came out, they have a whole tax provision, right? So if they're taxing it and they're going to make revenue, it'll be hard to, governments are addicted to taxing revenues. So if they're going to be collecting money, it's going to be hard to then say we're going to get rid of it, so we'll see. But if they start taxing, getting enough taxes from those digital assets, maybe not, maybe they won't get rid of it. Look, China tried to, right? We had that big collapse and it's right back up. So, by the way, I think China, a lot of wealthy people in China are having an issue now trying to preserve their wealth and get it out of the country, and what do you put it into? But let me quick, just so we spend, more time on the option straddle. I'm going to move through this really quickly and go to the option straddle. So here, I'm going to take a look real quick what's going on in the S&P 500 stocks, and then we'll talk about the option straddles. So in ETF, I'm going to take this filter here. Let's go SPY. These are S&P 500 stocks. So by using this filter, I'm just filtering out holdings in the S&P 500. Hold on a second. Let me just refresh my screen real quick here. So in S&P 500, so you see here 30 stocks made a percentage gainers list, 400 percentage decliners list. So from that perspective, we're looking at a bullish bias at the open. Lists aren't huge, but nevertheless, a little bit more towards the bullish side. So if there are no questions in there right now, well, I'm going to go to that straddle. No, Will?
Sure. Right. Yep.
So I'll just go to the SPY. And what I'll start out with is, let's go to the options. And I'm going to go to the strategy benchmarks. And this is just kind of benchmarking different option strategies. So you get a sense right now of like where it's priced relative to history. Okay. So on the straddle, I see here, this is a 1 month straddle, so 30 days to maturity. Right now, that straddle costs 2.7%. Okay. Versus historically, it would be 3.5%. So when we think about a straddle, like I'm going to try to use kind of a football analogy, because a straddle is really you're buying a call, you're buying a put option, and when you do that, you're betting on the magnitude of a move. Okay, that's if you're not hedging, you're just buying those two options. The stock has to move to the upside by enough to cover the cost of that straddle, or it has to move enough to the downside to cover the cost of that straddle. And when we think about it, like, well, what does that mean? Because it's still, I think, confusing to people. So I'm going to kind of give you a football analogy here. All right. When we look at it, so here in football, you can make different types of bets, right? So you could bet on a team, like team, you could say, I think team A is going to win over team B, right? Or you could even handicap it, but there's a different type of bet. It's called over and under, right? And over and under, does anybody know that? It's based on points. All right, over and under points. So what they say is like, let's say 55 points. That means that if you combine the points of each team, whatever they scored, right? And you could say, will it be above 55 or below 55? So it's just an over and under. It does not matter which team wins, right? It doesn't matter if team A could score 60 points and team B scores 0, you're over 55. Or both teams tie and they score 30 points each, well, you're over 55. So it has nothing to do with which team wins. All it's saying is it over or under a certain points? Okay. So that's kind of what a straddle is. So straddle is saying, but here's the thing, it's not just over and under. The payout is based on by how much, right? So when we talk about team A and team B, if you say, I think it's going to be under, well, by how much? So let's just say team, whatever the score is, it's 3-0, right? So if it's 3-0, right, that's 52 points away, right? So if it's 3-0, that's the final score. That means if you bet under, you would get 50, let's say $52, right? And somebody has to pay you $52 who bet over. Or if it goes the other way, and let's say this, if you bet under and the score is actually 60, well, you bet under, but it went above by 5 points, so you owe $5 to the person who bet over. Okay, so that's kind of what a straddle is. But you could see that if you sell it, if you go under, theoretically, team A and team B could just keep scoring many, many points, right? There's no limit to how much scoring they could do. So that's why when you go under, just like when you sell a straddle, you're not sure, where the points will stop. Is that making sense with like an over and under analogy? And I know Jake likes football analogies, so that's what I was trying to. Does this kind of make sense?
I think it's making most sense to most. I know a couple chameleons said they just don't understand football, but this isn't a.
They don't. Well, do they understand just points of any team? It doesn't have to be football, right? But when two teams play each other, right, they have to score, right? It could be basketball, could be whatever sport, soccer, right? So you have two teams and they each score. Well, if you're combining the scores of two teams, right? Whatever two soccer teams, what is the combined score? Are they going to go over or under that amount? It doesn't have to be football. It could be any. Any two. You could apply to anything. Is that good?
Yep, perfect.
All right. So that's kind of like where we are with this, where we are with the straddle. So what does this percent mean? Well, what it's doing is saying that if we're looking at a month to go, right? So this is 30 actual days to maturity, right? So a month to go, I don't know how many, like 22 trading days, let's say in there. With a month to go, how much does SPY tend to move, right? In that allotted time, in that period, right? So on average, how much can it move? And so right here, this is saying that this isn't the average moves, this is the average cost historically, right? So historically, on average, the prediction is 3.5%. Okay, that's where the markets were priced. That on average, SPY would move 3.5% in either direction. Right now, we're at 2.7%. So if you're willing to, if you think that whatever your outlook is, that you think volatility will be greater than in the upcoming month, right? Because maybe stocks are getting more liquid, maybe whatever it is, your analysis says that I think that we're in for a big move in either direction. At this point, what we also see is that based on the straddle prices, we're getting at a discount to historical, right? So here we're seeing it's like a 0.7% differential, 0.75% cheaper than normal. People seeing that so far? So let me just go to the options chain here. So I'm going to have to find something, straddle that's almost a month out. So what are we looking at here? December 8th. So that's 22 trading days, a month out. So what does this mean? So if I go and I find the closest straddle, right, 469. So here, this is the options chain. These are the calls. These are the puts. So if I buy a call, right, so now I queued up, I'm buying this call, 661. Here it is, December 8th, buying the 469 call, 661. Then I go in here, buy the put, right? Now I'm buying the put. 698. I'm going to load that strategy. And here's what it looks like, right? So if the stock just sits here for the next month and expires here, then, you know, if you're paying $13.54 for that straddle, then that all goes away, right? That means all that premium, it didn't make enough of a move. It didn't move at all. So you lose all that premium. The person who bet under keeps all that premium. Okay. Of course, if it moves outside that range by more than this, then on the upside, it becomes profitable because your put will expire worthless, of course, but your call, the value of your call made up for the cost of the call. It made up for the cost of the put, and then it became profitable, right? So there you go. It covered the entire cost of this to the upside. And if we go to the downside, kind of the same thing, you know, the call will expire worthless at expiration, but if the stock goes up far enough, the put, you'll cover the cost of the put in addition to covering the cost of the call, and then it becomes profitable. So that's what the straddle looks like when it's unhedged. So why is it important? I'm going to show you that. As an options trader, professional trader, if I just bought the call, all right, so what happens here? Let's say I bought these 10 calls. I'm sorry, the 469 call, and I'm just going to buy 10 of these. All right. So if I bought 10 of these, this is what the call looks like. All right. This is like, you know, I bought the call. Obviously, if it just stock sits there, it goes down, I'm going to lose the premium on the call. And if it goes up enough, I'll start making it. But you could see here that the delta of this call is almost, it's a 50 delta call, right? So I have 500 deltas. So as a professional trader, I'm hedging those deltas because I want to be delta neutral, right? I'm just looking at it from the perspective of that the call is cheap, you know, the volatility is priced too low, and I'm going to buy the volatility, but I want to hedge my delta. So I don't want to have directional exposure, just volatility. So as soon as I hedge it, right, in this situation, and I'm going to show you what the chart looks like, it's going to look like the straddle, right? It's a synthetic straddle. So watch what I'm doing here. I have a exposure, directional exposure of 500. So I go in here, I'm going to sell 500 shares of stock, right? So I'm going to get this delta down to almost zero, right? So I'm going to load that strategy. You see what happens? Now I'm delta neutral, and I put on that straddle. So according, you know, and why I'm just kind of showing you the straddles, when you're delta hedging and you know, it starts to look more like straddles when you're doing an option and then hedging it. And this isn't at the money, so it's not going to look exactly like straddles, you know, when you're doing out of the money, but just wanted to show you kind of like that why straddles are important, because we kind of think of that way as professional traders. Okay. Does that make sense to people, what I just showed them?
Let us know if you understand or if you have any questions. We did have one question from Laurent D. He was asking, he starts at about straddles. Don't you have less risk on the downside because of the volatility rising? Did I lose you?
Bring up the straddle again. So I'm going to bring the straddle. Can you read that?
AD, you may want to change around the mic. You've become a sea chameleon. It's a little.
Is that better if I move it closer?
No, unfortunately, it's picked up my reverb. You may have to log in and log out and log back in.
Log out and log back in?
Yeah, please.
Okay.
All right, everyone. As Dimitri logs out and logs back in, remember we have a webinar on Tuesday. I will put that link in again for Tuesday's IBKR webinar. And that will be discussing different option strategies to consider around earnings. And the D-Man will take a look at different examples and use the screeners to put some ideas together. We just, for those who don't know, if you log into the Zoom, Jake is in the Zoom. And Jake's also a big football fan. Jake, you would enjoy the discussion that's gone on the YouTube chat this morning. Lots of football talk, but Jake was saying that Raj may have an idea on Discord to solve the underwater problem. I'll take a look at that today, Jake. Thanks for the heads up.
Yeah, it's weird because I have the mic all set up. I'm not sure why that happens.
Yeah, well, we'll look at the Discord. Raj gave some reasoning that it may be happening, so I'll take a look at it today, see if we can solve that.
Okay, so what we did was really quickly, I'm looking at the straddle again, and one thing we looked at is historically, how are the premiums priced, versus how the premiums are priced now. But what about the realized moves, right? Like now we want to kind of take a look at, well, how did the stock actually tend to move historically, right? So those are two different things, right? One is just, did the market just tend to overprice it historically every time and maybe deserves to be lower? So that's the next thing. So now I have the straddle queued up, right? And I know, okay, I'm paying $13.54. Is that though a crazy number a crazy price to pay based on how SPY historically moved, right? During the 22-day trading period. So that's where this comes in, the distribution. So now I'm looking at it. Now I'm looking at last 4 years. And, if I'm going to look at percentage moves, right, for over a 22-day period, what would this straddle be priced on average? So this is ignoring even it doesn't matter what the premiums were. This is actually looking at the actual percentage moves of SPY. And we see that based on that the average end value, if we use historical percentage moves, is $15.87 compared to today's market. So here it does seem that straddle is now, below that average, below that historical average. Again, and this is only, you'd still have to have the outlook that you think that there's going to be volatility in a movement in the next month. But if that is your outlook, the next thing goes, well, are we getting a good deal or not a good deal from paying up? How much? So here we see that it's a kind of a pretty good discount, almost $2, right, from the historical average. And then the question is, well, if we did buy it, I know that this is the average, but if we did buy it at $13.59, right? So if we're assuming that if we buy it at $13.59 right now, it has to move 2.7%, something like that. So how often would have this been a winner? How often would this been a loser, right? So I know the average value, but then the question is, well, how frequently? Because the average could be, one time it moved a gazillion, right? So how frequently would have it ended in profitability? And that's what this win rate is, 43.5, which means that if in the last 4 years, if we went back 22 days, right? How often would have it covered this cost? That's 43.5% of the time, which for straddle, actually, that's not bad, because when you think about it, what straddles like a standard deviation, you're looking at about a third of the time, right? So right now, this statistically looks like good do, assuming that, we get some movement, and we can, right? Nobody really knows it. It's impossible to say that for the next 22 days, the market will not move and there won't be any news. So just really quickly, we're up at almost at 9:30 if you have any last questions, but I kind of wanted to introduce that straddle. Then the next thing I wanted to talk about, maybe this will be the follow-up, is well, when do we use the implied volatility and when do we just want to look at the cost of the straddle? Because those are two different things. And when we look at implied volatility, you're using a model to price it, an option pricing model. And there are certain periods that model is not appropriate. Okay, so in certain periods you could use the model. It's appropriate in certain times that model, it doesn't fit. Okay, it doesn't fit the circumstances. So we're going to talk about that moving forward, but I kind of wanted to.
Jeff did have question, and maybe you want to get into tomorrow. He was asking about the distribution, I guess, theoretical value and IV theoretical value tabs, and how you use them. What are they helpful for?
Right. So we're going to go through all these, you know, kind of step by step. That's what I'll do slowly. But at first, I just wanted people to kind of understand what the straddle is, right? And then we'll talk about the IV theo distribution, the difference, and you're going to use them. You could sometimes use them together. You know, you want to look at both. Sometimes you only want to look at one and not the other. And sometimes you want to combine strategies. So we're going to kind of like move forward and discuss these tabs. But hopefully people got what the straddle is, right? So they understand this first.
All right, perfect. Well, we learned a couple things today. First of all, 60% of chameleons over 30 votes believe Bitcoin will be worth more than Tesla in 5 years. I also learned that the doctor, the only day he takes off a year in Malaysia is the Super Bowl. So if you're ever in Malaysia, it'd probably be worth to catch the Super Bowl with Jake. That'd be fun, I think. Thanks, Dima. Well, great job.
And Will, would it be interesting? If he ends up selling the 10% stake, right? He gets all this cash and he'll pay taxes on some of it. What do you think he's going to do with that money?
All right, we'll pull that on tomorrow. Let's all
will he buy Bitcoin
on Monday or on Tuesday's show.
Do you think he would?
What do you think? What do you think, Mr.
Will he buy some Bitcoin with it? You think?
Yeah, Mr. Musk will do with the $21 billion. Certainly, a chunk of that is going to go to his favorite government. But beyond that, what's he going to do? Is he going to buy Bitcoin? Is he going to buy?
What does he do with it?
What's he do with it?
Yeah,
it's an interesting question. Let us know what you think. Maybe we'll poll on it tomorrow. Great job, Dima.
All right. Thanks, everyone, for joining. Stay safe out there. Have a good trading day and hope to see you guys tomorrow.